What did you say? You have some money lying around and don't know what to do with it? Well, we have a great solution for you. Invest. Or more specifically, invest in the stock market. Welcome to 5-Star Finance. What is the stock market? A stock market is an index of buyers and sellers which represent a certain claim or ownership of publicly presented companies, investments, shares, and securities. In simpler terms, a stock market is a place where buyers and sellers post their companies, stocks, shares, and investment opportunities to be bought or sold. Kind of like your well-known eBay, for example. A seller posts an object of interest for others to buy. Similarly, many firms, companies, and businesses present shares for others to buy part of, or sometimes the whole of it completely. What are stocks? Normally, a company, business, or corporation is divided into parts, which represent some ownership of it. These parts are called shares, also known as stocks. A single share or stock owned by an individual represents fractional ownership of that company, business, or corporation under the name of that individual. Once a stock has been owned by a specific individual, it grants that individual a part of the company's earnings and voting power proportional to how much money that individual has invested into the company. You could literally become the owner of a company you love or admire, with the rights to receive a portion of the profits and even the power to vote and determine its future. Yes, we're not joking, you really can. As we've said before, stocks grant you a part of the ownership of a company. Besides the CEO and its employees, a company needs investors so that it can expand and make more money. As soon as you start investing in that company, you are granted a certain ratio of ownership, unless you plan to buy the entire company. Now, the more you invest, the more the ratio increases in your favor. Then you get parts of the profits the company makes, most of the time in the form of shares as well, and at some point you have enough shares, you are also granted the power to vote and determine what will happen to the company itself. For example, let's consider the newly growing company, Tesla Motors. Founded by a group of engineers wanting to produce electric vehicles for the world, a vision for the future. Though a small company, but one with confidence to run. And in February 2004, Elon Musk became the largest shareholder by investing a whopping amount of $6.5 million and ultimately became the chairman, with all the rights to determine the direction the company will go towards. How to buy stocks? Normally, there are different ways a person can buy stocks. One of the most common ways to buy stocks is through stock exchanges. Stock exchanges are marketplaces where securities and shares are bought and sold by investors and companies respectively. The most popular, widely followed exchanges currently in the United States are the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, and the New York Stock Exchange, with a market cap of around $27.69 T. The market cap is the amount of money you would have to pay or invest in order to grab all of the shares of a certain company, but not necessarily its true value. Buying stocks is generally divided into steps. Research. The first thing you need to do in order to buy a stock is to research it. Believe it or not, having firm knowledge about the stocks you are buying and the rate at which the market changes is very important when buying or selling stocks. There are many shares in the market that can suddenly lose all value and crumble, while others that may have never even thought about reaching such a high point in value soar through the skies. The market is in fact very inconsistent. Take, for example, Coca-Cola. A person thinking of buying a stock from Coca-Cola should research on how the stock's value holds in a certain time period. If it is inconsistent, it may be good to take the risk. You might grab the bigger fish or lose your line in the process. It's all up to the market. Hence, gathering knowledge on what stocks you want to buy is an important step for a beginner who wants to get into the stock market. Decision on amount of stocks to be bought or sold. Deciding on the amount of stocks you want to buy comes next. Buying up too many stocks or not enough stocks will make you unable to further invest or lose the profit in total. After deciding the type of stock you want to buy, go for an amount in the middle, which is not too high for your wallet or not too low for incremental value. Choose a stockbroker you are comfortable working with. Choosing a stockbroker may make it easier for your first time in the stock market for buying or selling stocks. A stockbroker is an individual or group of individuals who charge a certain amount from you to do all your work regarding ordering, buying, and selling shares in the stock market. Most of the time, these people have the best knowledge on how the market is running and what stocks are best to buy and what to stay away from, as well as how the market is going to hold up or change in the future, since the market and shares depend on the incremental and marginal value of the companies whose shares are presented to the buyer in the market. Brokers provide the buyers and sellers with lists of various shares and tools for research and reference. There are mainly two types of brokers. Full-time brokers. A full-time broker, as the name suggests, works at a higher level in brokerage than normal, providing the buyer with a wide variety of research tools, investment plans, advice, retirement plans, and much more, but at a slightly higher price. A full-time broker is best for you if you don't want to physically take part in the process of investing and instead want someone else to do it instead. The results may be better than expected, but considering the fact you haven't gained any experience and paid a large amount as a fee for the brokerage, it may not be the best option you have. Discount brokers. Discount brokers work like normal brokers, but with a discounted fee and services. Discount brokers provide you with similar results as full-time brokers, but do not provide the other services such as investment advice, retirement plans, etc. They are best if you want to partake in your own investment decisions and are comfortable with using different exchange outlets for your transactions. Friendly reminder, if you're new to the channel, please hit the subscribe button. How to make money in the stock market? The most common way to make money in the stock market after investing is to use the buy low, sell high strategy. As the name suggests, you buy a stock for a certain amount of money. Let's say you bought a share of some company for $500. After claiming ownership of that stock, you then wait for the market to do its magic and increase the stock's value over time. That is when you decide to sell the stock at a higher price than you previously bought. This way you can gain profit from buying and selling stocks. Share price. The share price means the average value of a company, business, and corporation of a firm's stock. Adding up the total value of the stock's returns the total value of a publicly traded company, also known as its market capitalization. The range of prices of stocks are not obsolete. They can be low as $5 and go as high as several thousands a share. Currently, one of the most expensive stocks is that of Berkshire Hathaway Class A, with a share price of over $517,000 a share. Demand versus supply. This is a particular relationship between the number of shares and the number of buyers in the market. As the number of buyers coming to the market looking for shares to buy increases, the number of shares left to accommodate those buyers decreases, as the rate of increase of buyers is far more than the rate of increase of sellers in stocks. Hence, the prices of stocks increase with the increase in buyers. Normally, the sellers and buyers manage to negotiate and set a price both parties agree on. Hence, waiting and negotiating is important in the stock market. Dividends. Stock dividends are a way of providing the shareholders with rewards for buying shares without disturbing the cash balance of a company. Most of the time, it is in the form of dilute earnings per share of more shares itself. To collect dividends on a share, you need to have ownership of the shares through a brokerage firm or retirement plan, such as IRA. When the dividends are to be paid, the amount is automatically transferred to your bank account. Price versus value. At this point, you should have understood that behind each stock, there is a company. But not always the stock market reflects 100% the price of the company. Imagine you own a house that is worth $100,000, and one day some interested buyers offer you to buy that house for $60,000. Would you sell your house? Probably not. But what does this have to do with the stock market? Well, it's pretty much the same. The stock market shows the price a stock is currently trading, but not always the price that equals the true value of the company. This means that the same buyer who offered to buy your house for $60,000 can decide to sell that stock that is worth $20 a share for only $15. And that means you could buy dollars for cents. To determine the value of a stock, you need to know how to analyze it. There are a total of 6 stock categories, and the approach to analyze each one of them is different. We added a free ebook in the description if you want to learn more about it. How to analyze stocks? The most common way to value the price of a stock is to study its price-to-earnings ratio. The price-to-earnings ratio is the price of a company's stock divided by the most recent earnings per share of the company. This ratio helps determine the value of the stocks of a company when compared to the ratio of stocks for other companies' stocks. The company with a PE of 10 means that if the company can continue to maintain its earnings stable, in 10 years the investor would get a 100% return of his investment or a 10% annual return. This means that if you compare the price-to-earnings ratio of 2 similar companies, the one with the lowest ratio is probably the best to invest with the current price. In other words, the PE ratio helps investors get a general idea of how attractive the current price of a company and its stock is. And there you have it, folks. How to invest in the stock market for beginners. Do you feel confident to start investing in the stock market now? Let us know in the comments. Subscribe and turn on notifications so you never miss another video. Check out this video we handpicked for you, and we'll see you in the next one.